So here you can see we have the adjusted close stock prices for the last 10 years for both the S&P 500 index or the SPY ETF, and then the Intel stock price. So we're going to compare Intel's stock price performance over the last 10 years with the S&P 500 performance to see if Intel would have been a good stock to have held for the last 10 years relative to the market. And in order to find that out, we need to find the price changes for both on a daily basis for the last 10 years. So we'll just do equals the price of the stock one day minus the price of the previous day divided by the price of the previous day. Then I'll control C on my keyboard, control down arrow, and then control shift up arrow, and then control V to paste all of the values. And then we can do the same thing with Intel. We'll just take that price of one day minus the previous day, divide by the previous day, and that gives us the stock's return on that day. And we'll just go control down arrow, control shift up arrow, and then control V. So now we have 10 years worth of price changes for both the SPY and Intel. Now we want to calculate Sharpe ratio, which is really the most common measure of stock price performance or stock portfolio performance. And in order to do that, we need a risk-free rate. So one thing we could do is we could go find the average, let's say 10-year treasury for the last 10 years and use that rate, but I'm just going to approximate it by saying 1.5% to make it simpler on us. And then we need to find the annual return for both of these stocks, which will just be equal to the last price. So I'm doing control down arrow on my keyboard divided by the first price of both of them, and then to the power of 1 divided by the number of years. So this is a 10-year period, so we'll just take that value to the power of 1 over 10. So we find that our annual return for the S&P 500 index is about 13.62% for the last 10 years. And then for Intel, it's about 7.96%. So already Intel's not looking as appealing because it has a lower return, but it could save itself by having less risk, right? So we're going to calculate annual standard deviation for both, and we prefer a lower annual standard deviation because we prefer less risk. Okay, so let's do equals standard deviation dot P, and we'll use P instead of S. That's population, because there's so many observations in this sample. Really is truly more of a population. And then we'll multiply that by 252, so the number of trading days in the year, to the power of 0.5. So taking it to the power of 0.5 is just a shorthand way to do square root. So we'll take the square root of 252. And so we find that the Sharpe ratio, the annualized standard deviation for the S&P 500 index or SPY, the ETF, is 0.164. We can copy that and paste it with Control V over here and find that the annual standard deviation of Intel is 0.296. So now we have everything we need to calculate Sharpe ratio, which I've put the formula for right here. So it's equal to the risk of the return of the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. And so we find that we have a Sharpe ratio of 0.737 for the S&P 500 index and a Sharpe ratio of 0.218 for Intel. So we much prefer S&P 500 over Intel over the last 10 years because not only does it have a higher annual return, but it has a lower risk. So the best of both worlds, truly. If you don't fully understand the Sharpe ratio, take a look at my video that's about to pop up here that really explains the fundamentals of the concept at a basic level. Thank you for watching.